Past performance is no guarantee of future results. Content is offered for information purposes only. Unless stated otherwise, any and all individuals participating in the video are third parties that include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Unless stated otherwise, the views or opinions expressed may not reflect those of Seeking Alpha as a whole. The accuracy and completeness of content shared cannot be guaranteed. Seeking Alpha does not take account of your objectives or financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. Hey everybody, it's Nicole Benjamin, your host here at Seeking Alpha, to bring to you another episode of Portfolio Pulse, where, as the name suggests, we're keeping a pulse to all the big financial moves happening in the market. Now, for today's episode, we're going to be diving deep into all things MCO and SPGI. And to join us and help us do that today, I have Luca Socci. So Luca, thank you so much for joining us today.
Oh, thank you for inviting me and having me over. It's a pleasure and an honor.
Yes, absolutely. So I see you've been on Seeking Alpha since 2022. So tell us a little bit more about your financial background, your investment philosophy. What got you on the platform in the first place?
I began my Seeking Alpha journey a bit before 2022. That's when I became an analyst. But, before being an analyst, I was actually an investor, a retail investor. And I actually got more focused on investing when I got married and I had kids, because I started thinking about how to build wealth for them too. So basically, I started investing because I want to leave them something when they'll be needing it.
Now, I want to jump right in. You recently wrote an article on MCO and SPGI. And in your article, you talk about how Moody's is safer from AI because its models are required by law. So with that in mind, and Moody's 97% retention on AI, do you think this AI fear is kind of overblown?
Mostly, yes. The real fear, the real AI threat that investors think can impact on Moody's and S&P Global is data commoditization. That means that if you use an LLM today, you'll see that compared to a few years ago, they've become a lot better at pulling data from raw PDF files. Okay, so investors think, why do I need to pay S&P Global or Moody's in investing platforms to retrieve data that I can easily pull with my new agent that I can craft myself? And that is partly true, okay, but that doesn't understand what Moody's and S&P Global do, okay? Because what is very important is not only pulling data. We agree that this is something that AI will do for us. But what we need when we invest is that we need verified data. We need someone who takes the liability to say, okay, that number is right or wrong. Okay, we need someone to be accountable for, and that cannot be AI. It needs to be a reality where human beings are part of it. So that means corporations. In Moody's and S&P Global too, they offer they offer verified data.
You also talk about how these companies are counting on a wall of debt to be refinanced in 2026. So with that in mind, is this single digit growth of these interest rates like a sure thing, do you think?
Nothing is sure in the investing world, as we are seeing every day. And so there are two things that matter here. The debt wall is sure. I mean, companies borrowed cheap money in 2020 and 2021. This is a fact. They did that. Okay. And in addition, private credit is also growing, and private credit has a shorter life cycle. So it needs to be refinanced in fewer years compared to public debt. And so this is something sure. We have a lot of debt, cheap debt outstanding, and it comes due in 2026 and 2027. but 2026 is the big wall. So the real question is whether companies will refinance it or not. But most of them do need to refinance them because they don't have the cash to pay it down. They need that money. They need to for their life cycle. So it doesn't really. So the thing comes to when the companies will decide to do this, and to this extent, a big variable could be the new Fed's chair policy. If interest rates will go down, that maybe some companies may decide to postpone their refinancing and their debt issuance to the second half of the year instead of the first half of the year. So that's a big variable. But the fact is that a big debt maturity wall is coming in 2026, and this is a big tailwind for both companies.
Now, Luca, I want to ask, S&P Global is having a spinoff of its mobility. So with that becoming a higher profit company and, investors considering this for their portfolio, is this divorce, so to speak, really a bargain, or is that a sign that the growth is actually slowing down?
It's actually the thing that makes me a bit more bullish on Moody's right now than S&P Global, because S&P Global has to face the spinoff, which is not really clear on a few variables. For example, we still don't know the distribution ratio. So we know that S&P Global will separate the mobility division into a separate company and give some shares to its existing shareholders. But we don't know the ratio between existing shares of S&P Global as it is now and the spinoff. So that's something that matters. But also, I think many investors fear this spinoff because they will end up owning shares of the new S&P Global with ExxonMobility and the mobility company, which being linked to the automotive world, it's a car data business, so to speak. Investors fear that it will be given lower multiples compared to the whole S&P Global as it is now.
So Moody's is aiming for a 53% profit margin, which is honestly huge in comparison to other industries. So I guess with that in mind, you said you're bullish on it. What is it in their business model that allows them to get, 50% on every dollar that they're making?
There are three things: low marginal cost, almost no competition on price, and mandatory demand. When you rate debt, the only cost you have is very tiny. A team of analysts, a proprietary model you developed, and your reputation that you built over a century. So the cost of issuing debt over and over becomes very lower and lower every time you do that because there is a low marginal cost. There's also no competition in price because basically Moody's and S&P Global together with Fitch are an oligopoly on debt rating and mandatory demand. That means that companies have to get their debt rated if they want to pay the lowest possible interest on that debt. If they don't get the debt rated, they'll pay higher interest. So it's in their interest to get their debt rated. And this is what makes Moody's business so exceptional.
All right. Well, we'll leave it right there. Thank you so much, Luca, for joining us today. And for everybody that's listening in, go ahead, click the follow button on Luca's page. Go look into Moody's, see if S&P Global is going to be right for your portfolio. And we'll see you here next time on another episode.